Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Dan Bird. How you doing, sir?
I'm doing very well. How about you?
I'm doing great, man. So this is going to be video number 1, where we review the stock market for week ending October 21st and take a quick peek at the week ahead. So, Mr. Bird, what did you see last week?
So, interestingly, we had a little rally on Friday.
Yep.
I'm going to show, and in my newsletter, actually, let me show my newsletter. My newsletter, I talked about that and the fact that we might actually be rallying here for a little bit.
Yeah.
So
I don't know if you, yeah, I think I gave you that access. So I don't know if you agree with this, but I think the Friday rally really was on the back of the hope that Mary Daly's comment is the Fed pivot, right? Mary Daly talked about the Fed having to at least start talking about slowing down. And I think the market's like, yay, Fed pivot, time to party. And I'm looking at this going,
it wasn't that big of a rally.
Well, I didn't the market start off?
I wouldn't be throwing confetti and,
yeah. Yeah, but I think
noisemakers and all that.
Yeah. Hey, so I think I think that's what it was.
I don't disagree. I think that was a good catalyst for it.
Yeah, and we'll see if there's follow through into Monday. But I just want to say right here, right here, right now, the Fed slowing down is a disaster, in my opinion. It is a mistake upon mistakes, in my opinion. And I think you disagree with me. So I thought we should at least hit that topic up front.
I disagree.
Awesome. I love disagreement, respectful disagreement.
So first, tell me why you think it's a mistake.
So again, I've read many articles about it. So my understanding is she's not talking about a Fed cut. I think we both can agree with that. She's talking about a slowdown. 2, she has
a pause.
No, that's not what she said. She talked about the Fed should start talking about slowing down. There's no.
Well, so what does that mean? Slowing down. What does that mean?
That means
to me that means a pause.
That's not what it means to me at all. That means
does that mean continue hiking but smaller hikes?
Yes, exactly. That's what a slowdown is. A stop is a pause.
Yeah,
a slowdown is a 50, a 25. So here's my fear. This is why I think it's a mistake. And I'm glad we disagree. Mary Daly is not saying the terminal rate should go down. She's not saying that. So the terminal rate, depending on where you are in the Fed, is somewhere between 4.5 and 5.25. That's where they seem to be ranging today. Let's call it 5 just to have a number. Mary Daly is saying we are going to get to 5 slower. And I want the freaking Fed to get there faster. I want the Fed to get to the number so we can pause and rebuild. I don't want to walk in every 6 weeks and get hit with a bat. I don't want a quarter and then 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 a quarter. I want them to be done and done for a year at least. That's what I want.
So I think what would happen if they were to do that, it takes 8 to 12 months for rate hikes to show up in the economy.
Of course.
So if they were to hike faster, like you're suggesting, and just get to that nominal rate and then stop, then what I predict would happen is they would very quickly, like let's say they get there by December.
Yeah, in my world, just if you want to have this example, my world is they do 1 rate increase next year and they're done.
So 75 November.
75, 50 done.
Okay. So the 50 would be in January.
Yeah, January or early February, whatever that first meeting is.
All right. So if that were to happen, then by April, they would have to start cutting, not maintaining. They would have to start cutting.
Okay. And why do you think that is? Why?
Because we will be deep into a recession by then. And
Okay,
they will
so
start, and
are-
they will start cutting, and they will start cutting when the recession starts.
so let's play with this. You just told me, and you're absolutely right, that Fed rate increases take 6 months to play out.
Mhm.
So I am saying we're going to have rate increases November, December, and January, and you're telling me all of a sudden we cut in April. That's not 6 months. How, I mean, tie that out for me. If you're saying that the rate increase in January is going to have such a dramatic impact that we're already cutting in April, aren't you
No, that's not,
invalidating what
that's
you
not
just
what I'm
said?
saying.
Okay.
That is not
What
what
did I
I'm
miss?
saying.
What did I miss?
The rate increase in January won't show up until September, October.
All right. Okay, cool.
I'm saying that the first 75 basis point increase will
Okay.
show up in February, March. The first one, not the other two after
So
that.
what,
The first one.
so then what you're saying is come April, we're in a recession. Even if the Fed does nothing from today, we
Yes.
are in a recession in April.
If they stop, then we may be able to avoid a recession. Probably not, though, and I'm going to show you some things where I'm pretty certain there'll be a recession.
Okay.
The question will be, what is the depth of the recession going to be?
Okay. So do you think I just want to make sure we're on the same page. So you're saying they don't do anything today. Well, I think we all agree we're getting 75 November 2nd. I think everybody. So okay, we're at 3.75 to 4. If that's their last raise, you think the recession numbers start showing up late Q1, early Q2, 2023.
That's right.
Okay. All
And
right.
as soon as the recession starts, they will start lowering rates.
So okay. So we have negative GDP.
That's not a recession. That's not a recession yet.
No, I understand. So I'm just trying to get to the point. So now it's April. We have negative GDP. We have unemployment, which was the anchor that caused Q1, Q2 not to be a recession going up.
Right.
We've gone from 3.5 to, I don't know, 4.2, 4.4, whatever it is. Job openings in the JOLTS reports, which currently is 1.6 openings for every unemployed, goes to 1.2. Big names start laying off. You think the Fed is, as soon as April or the meeting around there, takes us from 3 and 3.75 to 3.5. Oh, your internet's down.
That's not the internet, it's stock charts.
Oh, stock charts is down. Oh, we can't go there.
Performing maintenance. No, come on, not right now.
Not on Sundays. Do they not know when you and I talk?
Apparently they don't.
Oh, well.
Well, that's interesting. I wonder what my other charts. I actually loaded some charts before that happened, so we'll see.
We'll see if it happens.
All right. Well, let's keep talking because I had a chart in here on what the rate hikes look like. But
so as you sit here today, again, I think we agree that we get 3 quarters on November 2nd. I think we both agree on that.
yes.
Where we disagree is as soon as December. Do you see anything happening in December?
I think we probably will have one in December, but
And that'll be the last one.
I think the narrative in November will be, we want to see how all of our rate hikes will play out.
Yeah. Okay. Yeah, I definitely think you heard Powell at his Q&A session post November 2nd rating is going to talk about what a slowdown looks like. I agree with that. Yeah,
that's right. He's going to say we have done a lot. The economy is starting to respond, not as fast as we would like to see.
I agree.
But it takes some time for these things to work through. And we want to see what the effect is going to be before we go too far. Okay. And I think his fear is, I think he's on the verge, after he does 75, he's on the verge of the fear in the Fed being, we are going to go too far. And if that happens, he's gained credibility so far with his cuts.
Yeah.
He is in danger of losing credibility again.
Right.
If he goes too far.
Yeah.
And if he goes too far, remember 6 to 8 to 12 months for these things to play out in the economy. If we start into a recession, which we will probably be in a recession, then it'll be too late at that point. Okay. He will have to start cutting dramatically if we go into a deep recession. And he doesn't want to do that either.
So let me just ask you this. So clearly you think he cuts if he gets to the terminal rate of 5. Let's say he gets to 3.
No, that's not what I'm saying. That's not what I'm saying. I'm saying if he gets to a terminal rate of 5,
Mhm.
and he does that quickly,
Right.
that will push
Quickly.
the
Okay.
economy into a recession.
So if he gets there
And
slowly.
that will cause him to start cutting, not because the terminal rate is at 5.
Okay. All right.
But because it will push us into a recession, and then he will start cutting.
So if they got it to a terminal rate of 5, let's say by next October, right, where they're actually skipping meetings. Oh, we'll do 25 and skip, and 25 and skip. You think that is better? Meaning less chance of
I think that will maintain his credibility. I think it will allow the tax hikes to take effect. I think inflation is coming down anyway. So yeah, I think that would be a more thoughtful, deliberate way to do it. I think just raising to 5 as fast as possible and then stopping, I think, is an irresponsible way to do it.
Yeah, so that's awesome. I love this conversation. One thing I will absolutely say in my vision of going faster, I think one thing has become certain after the UK pensions fiasco, whatever you want to call it. Yeah, something in the rest of the world breaks. Probably lots of things break.
Yeah,
which could be a bigger problem and cause.
Yes, and he knows that. He knows that, he's believe me, he's watching the 10-year go up dramatically. I mean,
he's looking at
the 10-year rate is going up even before he does another rate hike.
Yeah.
So I mean, he can talk up the 10-year rate and do it without even doing a hike.
Yeah, no, I agree. Okay, I like this conversation.
So that's what I think. I think, and when these Fed folks talk, they don't talk in a vacuum.
No, of course.
They all get together and they say, we need to start putting out some feelers into the marketplace. And Mary, you're kind of a dove, and maybe you can start the process.
Yeah, exactly. I agree. Yeah,
so
this was a trial balloon.
Yeah, they're starting to seed it. I mean, like I said, it was a little rally, and it was frankly, it was a technical rally more than anything, which I'll show you here in a second. But it wasn't a huge rally, and we've still got a lot of work to do.
Yeah.
So
cool. All right. I love that conversation. Thank you. What else did you see last week?
All right. Well, this is my newsletter. If anybody's interested, there's no charge. Just send me an email to breakpointtrading@gmail.com. These are some of the excerpts from the newsletter, little cartoons. And this is from VectorVest, their strategy. Prudent investors should only buy stocks long when the market is moving higher, realizing that we haven't yet seen a green light in the price column accompanied by a follow-through day. So just like you said, we had a nice little rally, but we haven't seen a follow-through yet.
Right.
This one below is from Stock Traders Almanac, which does historical research. And this is over the past 21 years, what November typically has done. November is the first month of the 6-month best time in the market, in the stock market.
So again, this is November, not October.
This is November.
I see it. Yeah.
October is on the right over here. This is, we're nearly to the end, but one of the reasons I put this in the newsletter is last Wednesday was the anniversary of the 1987 stock market crash.
Yeah, the 22%. Yep.
And next Friday is the anniversary of the 1929 crash.
Got it. Okay.
Next week is also the worst week of the whole year for the market.
Oh, joy. Worst week. That's something to look forward to. Is next week is the worst week historically. That's great.
Historically, it's the worst week of the year. I put some data in here too. This is from Earnings Beats. Next week is S&P is usually down 42% annualized.
Oh my God.
And NASDAQ is down 63%. This is just next week.
Oh, that's in a week. Yeah, annualized return for the week. Yeah, right. Oh my God, that's
just for the week. Now this is historically, so it doesn't mean it's going to do this.
Oh no, of course it's fun to look at though. Oh my goodness.
Just means the odds are, And this is, let's see, today is the 23rd.
It
So
is, yes.
Monday down 72%, Tuesday down 47%, Wednesday down 84%, Thursday down 73%.
So when you say annualized, if I was going to take 84%, don't I just divide that by 12?
Yeah.
What's that? What the? I just got to
Five.
see what number that is.
Well, 84% is
Seven.
7%.
7% for the week.
No, the 84% is 7% for one day.
Okay, God, for the day.
That's
God,
just
right.
one day.
That's a day. Oh, that's one day. Oh my God.
Right.
Oh my goodness. Okay. All right.
Yeah.
But that's fun. That's fun to look forward to.
Yeah, it's fun. It's fun to look at these historical, and I love doing this, and I put these in my newsletter all the time.
Yeah.
But it doesn't mean that's what's going to happen.
Oh, not at all. It's yeah, of course. Yeah.
But everything I do, and the whole purpose of the newsletter is for risk management. So you need to be aware of these things. So I did start nibbling at a few things,
right,
which actually went up last week, but I didn't go all in. As you know, I like the ladder in.
Yep.
So I did 1/3 buys on a couple of things, and they performed pretty nicely.
Sure.
But I'm not going to add anything more to it this week based on this.
Yeah, I got you.
Now, after this week ends, and it's actually the 28th. So the next day after October 27th, the October 28th is the first day of the best 6 months of the stock market.
So, okay, that's good. So, okay, so finish on a high note.
October 28th. And the first week of November is usually a nice rally.
I like it. Okay.
So I'm going to see how it plays out this week. And if the ones that I did buy go down, I didn't buy a lot of it. Right. That's okay. And then I'll just add more to it.
Gotcha.
Preparing for next week and preparing for the next 6 months. Now, let's talk about that 6-month period, because that's a question that I had from a lot of people. Last week's newsletter, I said, beginning of November starts the best 6 months of the year. And I had quite a few people send me a note saying they didn't really understand what that meant.
Okay.
They said, does that mean I buy first week of November and then sell at the end of November? And that's not really what it means. This comes from Stock Traders Almanac. They do extensive historical research on what the market does. In this particular case, this is from 1950. So this is 72 years worth of data. And what they have determined, and they've actually created a strategy around this, is that the best 6 months starting on October 28th until April 30th, those are the best 6 months of the year. So for the last 72 years, if you bought in the beginning on October 28th, or let's take a 401k strategy, because that's the easiest way to think about it. Okay. So you have a 401k, you can't really do a lot of trading in a 401k. You could put it into an index fund like the S&P or the NASDAQ, right?
Sure.
Or you can move it to cash.
Okay.
You can move it to a money market.
Okay.
I was talking to my sister this morning, and she said, I have a friend who is freaking out because her 401k has gone down 25%. And she said, I'm thinking of just getting out. And I said, tell her this is the wrong time. Tell her that's the biggest mistake that novices make.
Yeah.
They buy at the top and they sell at the bottom. And I said, send her my newsletter, because I talk about this in the newsletter. I said, right now, don't sell, don't get out. Right now is the time to be in. And if you had gone to cash on May 1st in your 401k, then you would have avoided all of the carnage of this year.
Right.
Or actually, if you gone to cash in January, this time the 6 months didn't quite work out. Right. First 3 months were great, but the last 3 months of it were not good. Right. Although I did see that coming too. But just in general, over 72 years, if you move money in the beginning and then moved it out at the end on April 30th, moved it to cash, then that's these two on the left. So this is the best 6 months. You move it into the market.
So that just to say another word, that's timing the market. You're just picking a day.
It's basically timing the market. And, I love the folks on CNBC says you can't time the market because you have to be right twice. You have to be right when you get out, and then you have to be right when you get back in.
Sure.
And I disagree with that. You don't have to be right when you get out. You just have to be right within 10% of the market. And when you get back in, you don't have to be right getting in right at the bottom. You have to be right getting in within 10% of the bottom.
I like that. That makes
But it
sense.
still gives you 80%
Right.
that you can gain, right?
Yeah, you missed the
So
tail.
no, you don't have to time the market on the exact day that it starts falling or the exact day it starts rising.
Okay.
But this particular strategy here, and this is Stock Traders Almanac, where they've created a strategy, but they've done all the research. And this is the results for 72 years. If you just moved it in on October 28th, left it there, moved it out to cash, you might lose a little bit because you're not going to time the market exactly, right? So you're going to lose some right there. But if you just left it in a buy and hold strategy, then this would be your results right here.
So you're telling me that
sense?
3 million is better than 1.8? Is that what you're telling me?
Yeah, basically.
I kid.
It's 1.2 million better.
Yeah, it's exactly. Yeah, it's only 1.2 million. I like it. Okay, that's interesting.
All right, so that's what I meant by that best 6 months period. Now, again, for me, it's all about risk management, right? Yeah. So I know that it's better to be in the market November, December, and January. Those are the best 3 months than it is to be out.
Okay.
In fact, from a risk perspective, it's less risky to get in the beginning of that 3 month period than it is to even be in cash.
Oh, okay. Interesting. I like it. Okay.
So the next thing I want to talk about is, because a friend of mine sent me an article which I included in the newsletter, and it was a very interesting perspective because it talked about the 200-day moving average right here. It's at a generational turning point in stocks right now, and use the 200 week moving average, not 200 day, 200 week moving average.
4 years. Okay.
It's basically a year. It's actually, yeah, 4 years, 50 months.
Yeah, 50 months. Yeah.
All right, so 200 week, and I'll show you what that looks like. My point was, that is not a generational turning point. It's an interesting idea. The generational turning point was in 2009 after the financial crisis.
Right.
That was a generational turning point.
Yeah, that was the end of a bear market.
That was the end of a secular bear market.
Right.
So that's exactly what I want to show here.
So see, I'm learning.
So this is the secular and bull and bear markets. This was in the newsletter too. So this goes back to 1950, so 72 years. So you can see secular bull typically lasts about 18 years. Then we had a secular bear from 69 to 81, 12 years. And then from 81 to 2001, we had a secular bull. That was 20 years. And then 2001 to 2013, you could say 2009, which is the end of the financial crisis. Right. But it didn't really break out of the top. So you didn't know if it was going to continue higher until it broke this top right here.
I like that. Yeah.
Which is 2013. So regardless of which one you choose, we've got until 2029 or 2031, somewhere in that area, that this bull market should continue.
Okay.
All right. And that would be 18 years to 2031.
Yeah, that's generational. Yeah. Not 4,
all right.
4, you can see, 4 years is not generational.
That's right. 4 years is not generational. But if you got in 2009 and it was a 20-year or even 2013, and it was an 18-year to 2031, that's generational.
Yeah, I agree.
Okay. In this secular bull market here between 81 and 2001, can you pick out the 1987 crash?
Yes.
Pretty easy right there. But what did it do to the trend of this bull market? Didn't really do anything.
Yeah. What did it take us back? It took us back like a year and a half.
Probably, let's see. Well, it was about 91. It took us probably 4 years.
Oh, the other way. So the 87 crash took us back
87,
to like 86.
87 brought it down to here.
Right. So it took us back to 85, 86 levels.
This is 87. Yeah.
Right.
87 took us back to about 85 levels. Right.
Okay. Yeah. All right.
And then it took 4 years to recover.
Got it.
But then it continued up.
Yeah.
All right. So here we are now. We are in a secular bull market. You can see in secular bull markets, there are cyclical bear markets.
For sure.
There's a cyclical bear. There's a cyclical bear. But it didn't really break the trend line.
Right.
Same thing right now. Inside of this 2018 right there. Actually, 2018 was right there. This is 2020 COVID.
Yep.
And this is the cyclical bull bear market we're in right now.
Sure.
So when this one ends and we start recovering, we should continue higher.
Okay. I like it.
Now, one of the I didn't put this in my newsletter, but it's a newsletter that I read. And coincidentally, I read it after I sent my newsletter. And coincidentally, they talked about the 200-week moving average. That's the blue line.
Got it. Yep.
All right. And they said, this is what it looks like going back to 1964. And every time it comes down to the 200-week moving average, it would bounce off of it, except for these two periods. Except for these two periods when it didn't, when it broke through it, and we ended up having bear markets. Now, anytime I see charts like this, and hopefully your listeners will start to recognize this as well. Anytime I see charts like this, what's the first thing that I do? I figure out where the secular markets were.
Yeah, you layer those.
All right, so where were the secular bear markets for this? Right there.
There you go.
And where were the secular bull markets for this? Right there. Okay.
I like it.
Does that look familiar?
Yep.
So that's one thing that I do is I want to see when they say, oh, we had a, historically such and such happened and the market went down and didn't recover for 8 years. I'm like, okay, that was a secular bear market though.
Yeah, you want to go up a level. I get it.
That's what it's supposed to do.
I like it.
So it's important. So let's talk about where we are and where we're headed.
Okay.
Performance of the S&P before and after midterm elections since 1946. Now I put this in last week's newsletter. And the metric was in 18, in this case, I think they say it's 19, but in 18 midterm elections since 1946, how many of them ended lower 1 year later?
Not many.
0. None of them.
That would be not many.
Not even one.
Wow.
Not even one ended lower.
That's interesting.
So yeah, it's an interesting statistic as well. So we're in a midterm election. This particular chart here is 0 days after the election, right? So the election's coming up on November 8th.
Yep.
And this is regardless. And one of the things talking to my sister again, she goes, the election's coming up, and if the Republicans take back Congress, won't that make the market go up? I said, it doesn't matter. It doesn't matter if they're Democrats or Republicans. It does not matter.
Yeah. Okay.
This goes back to 1946. Midterm elections back to 1946, regardless of whether it's Democrats or Republicans that took over Congress.
Yeah.
0 times did the market go lower.
Okay. Got it.
And then to throw a little bad news into the mix here.
Oh,
This is the rate of change of the 10-year Treasury compared to the dollar annual rate of change, the US dollar. And it puts the economic crises in here. So financial crises, you can see 2008. So the gray line is the dollar, the blue line is the 10-year Treasury.
interesting.
All right. So sovereign debt crisis, the dollar went up. China devaluation, global recession, the dollar went up. Fed taper tantrum, 2018, dollar went up, then the Fed started cutting.
Yeah.
Right now, the dollar is right there where those question marks are.
Got it.
And the 10-year Treasury, now remember, this is the rate of change. It's not the absolute value.
Right. Rate of change. Yep.
Okay. So the rate of change of the 10-year Treasury is faster than it has ever been.
Ever
back
been.
to 1971.
Yeah, that could
That's
break.
another reason why the Fed is going to start to pause, because this is unsustainable just for the global economy.
Yeah, that is where I absolutely agree with you. Is what's right for us probably breaks the rest of the world, in my
Right.
opinion. Right.
Right.
Yeah, I agree.
And that eventually will break us.
No, yeah, the second derivative. Yeah. Yep.
That's right.
Mhm.
So this is another reason why I think the Fed is starting to set us up to, say we are still committed to killing inflation,
Mm.
but we have to start balancing what we're doing.
Yeah. So
It
again,
has to be
you're not calling for a lower terminal rate. You're just calling for us to get there slower.
correct.
Okay.
And actually, I don't think we're even going to get there. So I think the Fed will do 75.
Sure.
I think
So
in
that's-
December, and they will start to talk about, we need to balance what we're doing. We need to see what the effect is going to be.
Mhm.
We want to see how it's playing out in the economy. We are already seeing some effect.
Mhm.
And then they might do 25 in December.
Okay. So that's 100 basis points left in a
Right.
year. Okay.
And I think that recession will happen. Let me see if I already put these charts up, so I don't think they're going to go away because stock charts is upgrading.
You cashed
But
it.
this is the little bounce we got last week. It actually started right after the inflation report.
Mm.
Remember when we had that huge rally?
Yep. I remember. Yep.
Last week I was talking about FOMO,
Yeah.
fear of missing out.
Mhm.
We had that rally right here, and then we gave half of it back, and then we continued to rally.
Hmm.
So we had a nice rally on Friday, but it was a huge rally.
Mm.
But if we go all the way back to here, and this is something I always look for in charts, so those folks learning how to read charts, the market went down, the price went down. You see that red
Mhm.
line right there, but the momentum indicators went up.
Hmm.
So that the RSI, relative strength index, and the PPO is basically a MACD, moving average convergence divergence, but it uses percentages instead of actual absolute numbers.
Okay.
Which I like a little bit better. It basically looks the same though, but the momentum indicators went up when the market went down.
Mm.
That means that this trend is running out of steam, that this downtrend is starting to dissipate.
Got it.
When momentum goes up, as this goes down, then the downtrend is dissipating. There's fewer and fewer sellers.
Mhm.
So that's starting to show up here now. And even though next week is historically the worst week in the market,
Mhm.
we actually may get a rally. We first have to break through this 3,800 level, which is the high back here in the beginning of October.
Mhm.
Then we have to get through the 50-day moving average, which is at 3,900. And I think we might get stopped right there next week. We might get stopped at 3,800 actually.
Mm.
If not, we'll get stopped right there at just below 3,900. And then next week, because historically it's a bad week, we may come down again and then take off.
So you're
And
still looking for that end of year rally.
I'm still looking for the end of year rally, but it's a lot of work to do. We got to get to 38. We got to get through the 50 at 39. And we got to get through the 200 at 41.
Hmm.
If we do all of three of those things, then I think 4,800 is in sight.
I love the optimism.
All right. That's not optimism. It's just, that's just what this is telling me. And it doesn't mean it's going to happen. This
Of
could all
course not.
change. I mean,
Yeah.
the June low, the Bowley low
Yeah.
got broken.
Sure.
Although interestingly, it's kind of hanging around that area.
Mhm.
So it's not an absolute number. It's
Sure.
roughly an area, and hit 3,500, which everyone has been looking for since the beginning of the year.
Yeah, that 3,500 was yeah, the systems took over. The machines.
That's right. That's right. The machines took over. The other thing to notice is the put call ratio as the market continued down. In this case is from the end of September. So right in here, as the market continued down, the put call ratio went down also.
Very cool.
Which means traders are not buying puts as rapidly as they were.
For sure.
They are not convinced the market is going to keep going down.
Mhm.
They're covering their risk. They're getting out of, buying puts and starting to buy calls. They might not be buying calls again, but they're not buying more puts.
Not buying puts. Yeah.
right?
Okay. Yep.
Just a couple more things, and I know we've kind of extended here already, but just a couple of more charts to show on where we're headed. This is again, the put call ratio. This goes back 12 years. The gray line right here is that 200-week moving average. So that article that I mentioned before that I thought was interesting, I didn't say it was generational, but I thought it was interesting to use the 200-week moving average. And look what the market has done for the last 12 years. That's the gray line right here.
Right.
And every time it hits that 200-week, look at what the put call ratio has done. It's gone above 80 and started back down again. Each time. Right here, this is 2018. This is the COVID crash where it actually went through the 200, but very quickly came back. But each time the put call ratio went above 80. That just happened again last week. All right. Okay. So we touched the 200-week. Right. We touched that again. So I'm giving you reasons why I think the market is going to rally. Okay. All right. These are all technical. Like I said before, the Fed, the dove at the Fed, Mary, may have been a nice catalyst for it, but it was technically ready to go anyway.
Yeah, I was looking for an excuse. This
is the VIX, my favorite VIX chart.
Yeah.
The VIX right here is the gray, and then there's a 5-day moving average and a 21-day moving average. The 5-day is the red, the 21-day is the green, but the gray
VIX
is the actual
below 30. Yeah, below 30.
So every time the gray drops below the red, the 5-day, that's when I start to get alerted that we may be making a bottom. And if the red drops below the green, then that confirms it.
Got it. Okay.
All right. So the gray dropped below the red. And even though we had a couple of days over this last week period where the market sold off, it never went back. It never went back above the red. So it never gave me a red line again. And it's now the gray is actually below the green. So that's another reason why I think the market is ready to rally. Okay. This is the long-term 5-year chart. This is the low 34.91. This has the Fibonacci levels. I've showed this before, Fibonacci levels and the quadrant levels. And I said Fibonacci 50 was 35.10. I said that is a key level. That's a point where it's probably going to bounce. Now there's another one at 3,200. So that's still in play, that 3,200. And we're still within this downtrend line. Yeah. Right there. Yeah. So if we go up and we take out all those things that I mentioned before that we have to do. We have to take out 3,800. We have to get above the 50 at 3,900. We have to get above the 200 at 4,100. Right. If we do those things, that puts us above this downtrend line.
Yeah, above the channel. Okay.
And then we're going back to 48.
I like it. Okay.
Doesn't mean we will, but.
Right.
And this is the 10-year versus the 10-year. This is the inverted yield.
10 and 2.
And the 10 to 2, 10 minus 2. So this is the yield inversion. And the thing that I want to point out on this is when the yield inverts, and I had this in my newsletter too, when the yield inverts, the recession doesn't happen right away. You see it happened here, took about 6 months. Yeah. It happened back here, 2006, 2007, took about 6 months. 6 to 9 months actually, before the actual recession happened. And it took 6 months after the inversion started to increase, started to go up. I think I actually have this. No, I didn't put it on here. So it's not when the yield inverts, and the yield can stay inverted for a while. It's when the inversion starts to steepen. When the yield starts to steepen again, then it starts to go back up. I think I had one in here somewhere. Well, I didn't have it prepared, but
it's okay.
That's what happens. That's what has happened. So it's about 6 months after the yield starts to steepen. The yield has not started steepening yet. And if the Fed keeps keeps raising, it probably won't. Right. But when the Fed pauses, it could, so this is again all in my thesis that the Fed knows this. This is not new. You can just look at history and see it.
Mhm.
The Fed knows that when they start to pause, then the yield inversion will start to steepen, and 6 months later there will be a recession.
Okay.
They know that already.
Mhm.
So do they want to push us into a deep recession, or do they want us to have a shallow recession? But as soon as the recession starts, they're going to start cutting rates.
Okay.
And if they want to keep rates level for a long period of time,
Mhm.
then they can't raise them fast. They can't raise them really fast, because if they do, we'll be in a recession, a deeper recession sooner, and then they'll have to start cutting. So that's my thesis, that they're not going to make it. They're not going to get to 5 as quickly as possible. They might not even get to 5.
Do you think they get to 4.5?
Yeah, I think they will probably get to 4.5, 4.2 to 4.5. Yeah.
Okay. All right.
Yep.
Very cool.
But
Well, do
anyway,
me a
that's
favor, show me your newsletter one more time. And video number
sure.
2, we're actually going to look at earnings next week. We're going to look at some key
Yeah,
earnings.
there's a bunch of big earnings coming up next week. So all these things that I've talked about here, most of them I had in the newsletter, not all of them, but most of it I had in the newsletter.
Awesome.
Except for our conversation about the rate hikes.
That's okay. Breakpointtrading@gmail.com. If you happen to be listening on the podcast, breakpointtrading@gmail.com. Thanks, buddy.
All right.